Hey everybody, welcome back to the channel. I'm Sheen, your host. This is Money Matters. In this channel, we talk about money, finance, how to grow your money, how to invest your money, and how to make money work hard for you. Check out my other videos. If you like what I'm doing, please consider subscribing, give a thumbs up. It really helps out the channel. I do a lot of videos about credit cards, bonus points, like I said, money and finance, investing in stocks, the stock market in general. I go over individual companies, individual stocks. So please do consider subscribing, give a thumbs up. Okay, today we have a beginner's video. We're going to talk about the differences between ETFs, mutual funds, index funds, and basically individual stocks. And I'm going to give my opinion on each of them. I'm going to give you the breakdown of what are the differences and what are the pros and cons of each individual category. So we're going to go onto my whiteboard and I'm going to break it down for you. All right, this is what we're going to talk about today: mutual funds versus index funds versus ETFs. So what are the differences? So first of all of these mutual funds, index funds, and ETFs are essentially baskets of funds. They're all the same. They all are a huge basket that have a bunch of individual stocks in that basket. So they could range from anywhere from probably 60 to thousands of stocks per each basket. So in that sense, they're all the same. A mutual fund, however, is usually actively managed, meaning that there is a fee associated because there is a human or a group of humans that manage this mutual fund. And their job is to make sure that this mutual fund outperforms whatever they're trying to target. So if they're targeting a specific index, they're going to try to outperform that index. So these people need to be paid a fee. And these fees are usually higher because they have salaries that need to be paid. Index fund, however, is passive, and so is an ETF. And so they do have a fee, but they're usually lower. And these are usually even lower than index funds. So I'll put two arrows there. So ETFs, equivalent ETF to the index fund, is usually lower than the index fund. So what do I mean by passive? So passive means this basket of stocks is put together in order to match the index, whatever index it is. The most popular index is probably the S&P 500, the top 500-ish companies in the US stock market. So this index would be made to match the S&P 500. So it's usually going to do the same as the S&P 500. If the S&P 500 goes up that year, this index that tracks it will go up that year. If it goes down that year, the index will go down that year because it's made to track the index. Same thing with the ETF. It is tracking. It is also passive, so it is tracking whatever index. So now you'll see these are relatively the same with this little exception. Those fees are usually just a little bit lower on ETFs, but here are the other differences. Index fund, you can not trade like stocks. So what does that mean? So index fund is only, the transactions on index funds are only done once a day, and it's usually after the market closes. So if you wanted to buy a particular index fund, you would put in your order, and the order would not execute until after the market is closed. And when after the market is closed, there will be a cost associated to this index fund, and it would be whatever that day's price movement is. So at the end of the day, those prices are calculated. So if somebody was selling that index fund, the prices won't get calculated until the end of the day. And somebody who's buying that index fund, the price wouldn't get calculated till the end of the day. So these are only traded once per day. ETF, on the hand, are traded like stocks. So you could buy and sell ETFs throughout the day. Anytime the market is open, you could buy and sell ETFs just like you would a stock. So if you saw for an ETF throughout the day, the price was dropping, you could buy it at the lower price throughout the day it was dropping. And if you saw the same thing, this ETF all of a sudden went up throughout the day, you could sell it throughout the day. So that's one of the biggest differences between index fund and an ETF. For most people, this is not too big of a concern because most people would buy index funds and ETFs and probably hold them for at least maybe 3 to 5 years or even longer. So it wouldn't really matter that you could trade them throughout the day because you're only going to buy it once and then just hold it. So this really doesn't matter. This only matters if you plan to buy and sell throughout the day or in a relatively short amount of time. So that's one of the biggest differences. And then the next biggest difference is index fund usually has a minimum to invest. ETF, no minimum. What do I mean by this? So index fund, so one index fund, usually we'll use Vanguard, for example, on Vanguard because Vanguard is known for their index funds. One Vanguard index fund, minimum to invest is roughly $3,000 just to get started. On an ETF, there's no minimum. So whatever the price is for that particular ETF, it is the price that you can buy it at. So some ETFs, could be, I'm not sure exactly the numbers, but let's just say like $40, some could go up to $200 for one ETF. So you could get started with as low as $440 for one ETF of the same index fund. So essentially these are the same thing, but you don't need to plop down $3,000 to get started on an ETF. So that's one major advantage. So then why would somebody want to plop $3,000 if do you think it's just start with 40? So an index fund offers one big thing that ETF does not. An index fund is automatic, meaning if you wanted to buy index funds, this same index fund every month, you could set it up to auto purchase, meaning you could buy, let's say after you buy your initial 3,000, you want to buy another, let's say $300 every month. It will automatically, you could set it up to automatically buy $300 of this index fund every month, and it will just do it automatically. On ETF, you cannot do that. On an ETF, if you want to buy, you have to physically go into your account and choose what ETF you want to buy and how much you want to buy every time. So essentially, it's the same thing as buying stocks. There's no auto buy on stocks, unless you have like some type of limit buy that you set. But for ETFs, you would have to set that limit, or you would have to go in and buy it. There's no auto buy on ETFs. The other thing is dividends. Dividends on auto. So when you buy index funds, those stocks in the index funds, because it's a basket of stocks, they pay a dividend. So whatever percentage of that particular stock you have in your basket, you get a percentage of that dividend. That's money that comes back to you. On index fund, the dividends are set to auto, or you can set them to auto. And what does that mean? That means that the dividends that come into this account are automatically funded to buy additional of this index fund or whatever index fund you automatically set it to buy. So this is basically a set it and forget it thing. You could start with your $3,000 purchase and then set auto buy every month, for example, $300, and your dividends to auto reinvest into this. And also your gains, your capital gains are on auto. So all the money that is made from these index funds is automatically reinvested into the index fund or another index fund. And that is all automatic. So this is really a compounding. This is compounding. All the money that it generates, you put it back to generate more money. And so this is what is called compounding. And this is really powerful because we are humans. We might be really interested in ETFs, but 2 years down the line, 3 years down the line, things happen. It makes money, it makes dividends. And with the ETF, the dividends just sit in the account. It doesn't do anything until you tell it to do something. This is on auto. So it will just automatically reinvest everything. That's the really powerful thing about the index fund, is this auto and therefore compounding all of your gains. So there's really not a good reason to purchase an ETF if you are not going to keep up with it and make sure that you're reinvesting your dividends, make sure you're reinvesting your capital gains, and make sure every month you're buying additional of this ETF. If you are able to do that, then it makes sense to go with the ETF because it has the lower fee. And it's not that much lower. It's usually very minute, but it still is lower. So those are the big differences between an index fund and an ETF. Now going back to the mutual fund, so the mutual fund, you're paying this higher fee because it's actively managed. Think about the active manage. So these managers that manage your mutual fund, their goal is to outperform the market, to outperform these indexes. And I'll put up on the screen right here. So you'll see on your screen right here. So in 9 years, roughly 65% of mutual funds failed to outperform the S&P as of last year. If you go up to 10 years, 85% of mutual funds failed to outperform the S&P 500. And if you go for 15 years, 92% of mutual funds failed to outperform the S&P 500. So it is really difficult to outperform consistently the index. And it's been proven time and time again, mutual funds in the long run fail to outperform the market. So in my opinion, there's really no reason to be in mutual funds because of the high fee, and these fees can add up to a lot of money over your lifetime of investing. So there's no point in paying these high fees when most of the time it doesn't even outperform the market. You might as well just pay the lower fee and just do what the market is doing. But if you really wanted to outperform the market, my thinking, what I believe, is buying individual stocks. Individual stocks are the only way to outperform the market. And why do I believe that? Because the index, and under that is, mutual funds, ETFs, they're all in the same category. We're going to call them all one category, index and mutual funds and ETFs. They purchase a huge basket. Roughly 70 to sometimes over 2,000 plus companies. S&P 500 has roughly 508 companies. So they're a huge basket. They're not just a small basket. They're huge. They're purchasing 508 companies, 2,000 companies, 1,000 companies in each of these baskets. And the truth is, there just isn't that many great companies that consistently do well year in and year out. Out of the S&P 500, there's roughly 800 companies in there, although it's called the S&P 500. I would say probably only maybe the top 30 or top 40 companies consistently perform well. The top companies are usually Apple, Microsoft, Google, I believe Facebook is in there. So all these major companies are on the top, and those are the ones that get the higher percentage of what's in the index fund. But the rest of the 400 plus companies are companies that either you might not have heard of or that just don't perform well. So my opinion is, why would you invest in 508 companies or 2,000 companies when the majority of them don't perform well? My opinion is you're way better off in just investing in, let's say, 3 to 7 companies. And you can do that when you buy individual stocks. And these 3 to 7 companies, you could research these 3 to 7 companies really well. And if you do, you will have pretty good confidence that in a, let's say, 3 to 5 year time period, they will outperform the index. Outperform. In 3 to 5 years, if you pick decent stocks, they will outperform the index, because the index has all these crap companies in it that bring the performance down. The S&P 500 on average only does 8% a year. So if you're able to pick good companies, all you have to do is beat it by 8%, and you'll be outperforming on a yearly basis index funds or the S&P 500 index. So why would you buy so many companies when most of them aren't good? You might as well just stick with the strong ones. Apple, Microsoft, Google. So if you stick with maybe 3 to 7 of the companies that you've researched, and they don't have to be these top major ones, even small cap or mid cap companies that even if you research it and you look at their books and you look at their financials and you look into what they're doing, and you believe they're going to do relatively well in 3 to 5 years, it's better to just put your money into these 3 to 7 stocks that you can keep an eye on and manage. And if they're not performing well, maybe in the 1 to 2 year time period, you might just switch one of them out. But in the long run, you hold on to the ones you really believe in, and you're more likely to outperform the index, outperform the market. Does that make sense? Because the index just holds too many bad companies. You know, there's not that many good companies. There's not 508 really, really good, strong companies out there. So that's my thoughts. Thank you for watching. All right, guys, that's it. Those are the differences between ETFs, mutual funds, index funds, and basically individual stocks. So if you have any questions, please, you can leave a comment. I'll read all over your comments and I'll be happy to answer them. Consider subscribing, it really helps out the channel. Give a thumbs up, that also helps out the channel a lot. And I hope I cleared up some things in this video and you found some value in this video. Catch you in the next one. Peace.